Okay, let's get to our next guest. I'm delighted to say, actually, John Ricciardi's joined us, Head of Global Asset Allocation at Deuterium Capital Management. Hey, John, nice to see you today. Look, where do you sit on this fantastic debate about valuations and inflation as well? Is this inflation the real McCoy, or is it all going to come to pass? Good morning.
Good morning. I think it's all going to come to pass. We discussed this really, the last time was almost 6 months ago when we spoke, and we were worried about whether or not we had sufficient fiscal stimulus to progress the recovery and all the rest of it. And I mentioned that our models showed that we were going to get higher interest rates, probably by mid first quarter, coming on some accelerations in inflation, but really coming on a re-acceleration in the global cycle into Q1, Q2 of this year. It was very interesting to see it and to watch bond yields go from under 1%, around 90 basis points, up to about 170 is where we are now, particularly kicked up by recent figures in inflation. But the same models that we used about 6 months ago to warn us about accelerating prices and activity in February, March this year, are showing that the top, at least the short-term top for inflation, should be around, I would say, June or July this year. So that this is really a base effect. To have CPI up over 4%. We have to remember that I guess it was just about a year ago that we had negative energy prices in the futures. We were in the full COVID, the beginnings of the very deep lockdowns. We had one of the biggest recessions really in the last 20 or 30 years imposed by the spread of the virus throughout the Occident, and that it had a huge effect at that time on not only the output, but also the price of pretty much everything. We're getting a base effect. It's a year later now. And so you have, just a measurement effect on where we were, particularly as you've mentioned. I was just listening here. A lot of it was energy. You had suddenly cars. You've had, the commodity prices. Gasoline is essentially doubled over a year. So we have those base effects in there that are being, exacerbated by the normal effects of an expanding economy. I think in terms of investment, that we're still in a rather expansionary global cycle, that factory orders, production, exports, all are on the upswing and will be over the next couple of months, and that we may be very agreeably surprised as the markets assess that, yes, inflation jumped up according to base effects, but it will normalize, perhaps dropping back to something like half what we're seeing now, and that there will be much less pressure on the world central banks, and first and foremost on the Federal Reserve, as to when they have to change monetary policy, the very stimulative and market supportive market policy that we have in effect. And I think it's a little, for long rates, like what we had in January of 2019.